A lot of people get really worried about changes in yields and the impact on bond returns. It's pretty important to remember that the key driver of bond returns over the long term is actually income levels. So it's driven by the coupon that you paid for owning a bond. That income component dominates dramatically over the long term. In the short term, yes, yield changes do affect the capital value of bonds and therefore the total return, particularly over the short term. So I think the very first thing to say is fixed income by its nature, it's a defensive asset. Losses are possible in the short term, but in the long term, remember it's income that drives total return. Income levels are positive. We think that sets up a modest but reasonable longer term return expectation on fixed income. Now the second point really to make is around the magnitude of possible yield rises. We do think yields are going up. We think yields are going up. We think we're likely to see higher volatility in markets. We think we're likely to see risk premiums restored in riskier assets. With respect to returns on bonds from yield rises, well, magnitude's important, particularly as yield rises affect the value of bonds with longer times to maturity more so than shorter. So if you're exposed to to longer duration bonds, then you're at risk of some short-term capital losses. But we don't think the magnitude of yield rises is going to be dramatic. We think from here, probably we're looking in the order of 50 to 100 basis points or 0.5% to 1% yield increase in, say, the 10-year government bond for Australia and the US. It's possible that drives some shorter-term capital losses that overcome the income effect, but over the longer term, essentially the higher yields set up for better future returns from bonds. I think the other important thing to remember is to distinguish the cyclical from the structural factors that are driving bonds at the moment. What we're seeing here is an improvement in the cycle, so growth elevated, inflation starting to lift. These are cyclically driving yields higher. But the structural factors, so ageing demographics, the impact of globalisation and technology on inflation, those things aren't likely to go away. And while we're seeing this cyclical uplift, those structural factors are likely to keep a sort of a lid, if you like, on longer term bond yields.